Welcome to Subramani. Many people think that they should look at the portfolio of fund managers and then go and buy those same shares, right? It's a very sensible thing to do. At least many people think so. I do it regularly. Fund managers whom I like and some fund managers whom I do not like, fund houses which I do not like, I keep looking at their portfolios and see what kind of shares they own. But I will not buy a share just because they own it. I will buy the share because somebody, because my own research says it's worth buying, and then I look at, after I buy it or just before I buy it, I look for validation from some of the good fund managers, or I even talk to some of their offices and find out whether they are increasing. So you know whether they have. Do I know whether they have considered, whether they are bought or sold? I can get all those details. Whether they are considering to buy it, nobody is going to tell you that they are considering buying it. But you get some, you look at the data, you realize that, oh, in this industry they like this share more than that because they have given more weightage. Or these are some of the conclusions to which you can come. And even when you're attending some of the meetings with publicly available information, they're more willing to say why they chose this versus that, right? Oh, corporate governance is an issue, so we have a smallish stake there. Why do you even have it? Oh, in that industry, all companies have governance issues, right? If you get into construction or road construction or any builder, there is a limit to what you can't insist on. Very high qualities, they are just not available. Good high quality builders are not available in enough quantity at reasonable prices, so you may have to compromise somewhere there. But largely, when you find that a fund manager is good and has a good portfolio, the best thing to do is to go and buy that fund, right? So look at Berkshire Hathaway. So I can look at Berkshire Hathaway and say, oh, Coke is worth buying, American Express is worth buying, Apple of course is worth buying. So I could go and buy these three shares, or even more sensibly, I could just buy the Berkshire Hathaway share. It makes more sense to buy the Berkshire Hathaway share than try to do all this, because Berkshire Hathaway has got one good thing. It is in the most profitable business in the world. It is in insurance, both in general and life. It does a lot of underwriting, right? So when you do a lot of underwriting business, you get to understand a lot of businesses. So I'm sure people don't even understand that Berkshire Hathaway makes a lot of money from the airline industry by insuring planes, right? They may not be holding the shares of the airlines, but they're making money by maybe they're funding some airports, maybe they're funding some planes, maybe they're definitely doing insurance of planes, right? So those big business. So they are making money from the airline business, but they may not be making money by owning shares of airlines. So you have to understand who in the whole business chain who is making good money and try to get a part of that. How can you get it? It's simple. If you're Mr. Buffett or Mr. Munger, you know how to go about doing it. But the simplest solution for people like you and me is to go and buy the Berkshire Hathaway share. Has it underperformed the S&P 500? Yes, it has underperformed the S&P 500. But look at the logic. Which company, what should do better? The S&P 500 or a company managed by Munger and Buffett, right? So yes, it has underperformed, maybe 5, 10, 15 years it has underperformed, but the chances are now that they are sitting on so much of cash, they are likely to, maybe they'll start outperforming. And I'm not doing this as a time video. You may be seeing this much later than what I have posted it. So that's also possible. So the simple thing is, they've got a fabulous portfolio of long-term debt also. They of course have a lot of short-term debt, but they have long-term debt also. So when interest rates have moved up in the US, obviously some portion of their portfolio would have benefited by that also, right? Because they're sitting on a lot of cash, and cash largely means treasury bills and G-Secs, etc. So their longer bonds must have been making money for them also. So that is good. Then they sitting on cash means when the market is going up, they know exactly how to enter the market. They have always been good at that, and they make what, $30 billion or something as profit. They would be sitting on 300 billion of cash reserves. right? So they know how to deploy it. So why not buy the shares of Berkshire Hathaway instead of looking at their portfolio and copying? And this is true across any fund. I'm not even saying just Berkshire Hathaway. Any Indian fund house that is doing well, and that scheme is doing well, and that fund manager is doing well, instead of looking at his or her portfolio and deciding what to buy, it's much better buying the whole thing. Now it is also possible for you to buy Berkshire Hathaway shares in India a small bit by investing in one mutual fund. I'm not naming mutual funds because philosophically I've decided that naming is not really helping, it is hurting. Because when I name one, it means they all, especially if I name negatively, saying, oh, in this fund house I had this problem, the other 41 fund houses think that they have no problem. It's just that I have not considered them for doing something. That's about all. So I don't want to say this is a bad website or bad, sorry, I'm digressing. But the question is Berkshire Hathaway a good buy? To me, yes. Insurance is a good business. They're sitting on a lot of cash that is also spewing and throwing cash at them. So I think Berkshire Hathaway share is better than buying some other unknown share. Of course, if you're using LRS, you can do that. Or there is one fund, like I've said, there is one fund in which invests in Berkshire Hathaway. It's a value fund, so you can go and invest in that fund. You will get a small portion of Berkshire Hathaway because it's an India equity fund with 35% going into American or non-Indian equity, which is again because it's a value fund, they go and buy Berkshire Hathaway again as a world's value investor. So to me it looks good and sensible to buy a fund which is doing well, rather than look at its portfolio and say, oh, let me buy these shares, right? Oh, they got so much of Infosys and TCS, so let me buy Infosys and TCS, right? But they could actually be making money in some smaller software company rather than in the bigger software company. So you may be better off investing in a ETF, IT ETF, rather than going and picking stocks. You can do both. Nothing stops you from doing both. But instead of seeing where Berkshire Hathaway has invested, I think you will make more money by investing in Berkshire Hathaway, which you can do from India. Thank you.